Hello, hello, hello. We are live. Welcome back to another episode of Punch Card Investing. Unfortunately, we have no Jack today, so you kind of left with me as the host. I've volunteered to take Jack's spot. I don't quite think I have the hosting skills of Jack, but hopefully we'll battle through this. So today's topic is special situations. If anyone's ever read this book by Joel Greenblatt, you'll know exactly what we're talking about. Mergers, spin-offs, special dividends, any other kind of random, obscure, misunderstood situation is kind of the name of the game for this one. So if you've got any special situations you're looking at or any questions, definitely drop them in the live chat. And hit like. What else does Jack usually say in these intros? Hit like, subscribe.
He's got a whole thing. He talks for like 5 minutes.
Yeah. I don't know what to say. Episode 94.2 or something.
Right.
Yeah, exactly. Must be a lawyer thing. Anyway, right, let's get into it. I think we turned on Super Chats a few weeks ago as well, so absolutely no pressure. But if there are like a heap of questions and we just can't get through them all and you really want your question answered, that's a way to kind of move it to the top of the priority list. So let's get straight into it. I think, Frank, you volunteered to go first, so I'll hand it over to you.
Okay, so just talking with Tom before we jumped on air, special situations are the kind of thing that I would love to invest in more, but they are very time consuming. I think if you're running a portfolio full of special situations, you almost need to be a full-time investor. So the reason I've kind of stayed away from a lot of special situations is just because I don't have the time to put in the work and the research and follow it along closely. That's not always the case. I guess there's certain situations where that doesn't matter as much, and they're kind of the opportunities I'm looking for. So one person I think all of us here follow on Twitter, and if you don't already, is Jeremy Raper, who essentially only invests in these special event-driven situations. And as far as I can tell, unless he's really good at hiding his losers, he does very well on a lot of these special situations. The most recent one that comes to mind, and I kind of followed closely, being an Australian company, was Think Childcare. And essentially this was like a merger arbitrage situation. There was, when they were trading at about $1.10, I'm given rough numbers here. You could go back and look at it exactly, but this is the rough numbers. They were trading at about $1.10, and another childcare company called Busy Bees, I think it is, offered about $135 or $1.35 per share. So there's a decent upside just from that. And then another company started a bit of a bidding war. They offered slightly higher at about $1.45. Now, 12 months later, between this bidding war going back and forth, the shares are currently trading for about $3 something, with those two companies still bidding for a complete buyout of Think Childcare. Before all of these offers started coming in, the kind of downside protection I guess you could get from this trade was it was already a great company. It was growing at about 20 to 30% per year. It was a relatively new company. I think they were founded in 2015 or so. The returns on equity and invested capital and everything else were really great. High insider ownership, most of the typical things you would like to see in an investment. The one downside, I guess, was there was a lot of debt. They were funding a lot of their growth through debt. So that's the one weakness, I guess. But there was really no risk at $1 or so when we first kind of heard about some of these buyout opportunities. There was really no risk going into it. It was a high-quality company that was probably going to continue to grow. And then as soon as we got that first announcement from Busy Bees offering the $1.35 or whatever it was, there was really very little downside and a rough 20% or so, whatever that mass works out to be, of upside if the buyout went through. But like I said, it's just skyrocketed through to now $3.19. You can see on the screen where it kind of flattened out recently. That is the most recent buyout offer, I think, is $3.20. So it's just kind of hovering there right now with shareholders just kind of waiting to see what the next bid is. And at this point, there's no clarity of what's going to happen. But if you're backing it from about $1, it'd probably be a nice time to exit. I don't think they're going to offer too much more than it is at the moment. But that's one that played out very well that I kind of just watched from the sidelines.
Yeah, very nice. And Sorry, I might have just completely missed it there, Frank. But is the bidding war sort of still going on, or there's been that one offer that's been sitting there for a while, and does that have some sort of date on it? Are you familiar with that?
I don't know exact dates. I know the most recent offer was that $3.20. I don't think it's gone through. There's been no buyout or anything as of yet, and I don't know if there's another bid since then. But I think that's why it's hovering at around that $3.20.
Mm-hmm. Yeah, very nice. Jeremy's a badass. He is. I don't know how he finds this
Jeremy
stuff.
doing? Like, what's he doing? Like, is he approaching management? Is he trying to do something here?
He has gone into like some activist type roles in the past, but on this one, I don't think that's the case. I think he's up, if he still holds it, he's up 200%. So I think he would care very little at this point. He could exit if he needs, but at this point, he's already succeeded. He was looking for about a 30% upside over a shorter time period, and it's just been a crazy bidding war since then. So I don't think he minds too much on this one.
This sounds quite similar to Total Beach. I think you're familiar with Total Beach too. I know Jack's a shareholder, but they've also recently been receiving a lot of bidding offers, and kind of reminds me of that a little bit.
Yeah, I haven't followed Turtle Beach too closely since maybe about a year ago when it came up on some screens, but I know they got one offer that was about 30% above their share price, but I wasn't sure if there was multiple bidders on that one. If there is, then that would certainly be an interesting one to follow. We need Jack here.
We need Jack here for that one. Yeah.
Jack.
Yeah, I haven't got that skill set to tell you about Turtle Beach. Sorry. Cool. Who's next? Crown, what do you got for us?
Sure. Yeah. So I thought the most interesting special situation is one that I actually went through. Was GameStop, but I'm not exactly going to talk about the short squeeze. I wanted to explain what happened prior to the short squeeze. So in 2019, we all know that Michael Burry approached the GameStop board. But for some reason, I guess a lot of people miss the fact that he told them to buy almost 80% of the total outstanding shares. So in 2019, the company had roughly 480 million in cash, and their market cap was around 280, around 300 million or so. So what he suggested to the board is that go out and buy up to 238 million. So I'm just remembering these numbers because of all the study. I don't exactly have them, but it's around 238 million that he told them to completely buy out from the market. And the company could have issued that buyback at around $3 to $4 per share, which is far away from the current stock price. I think this current stock is like $200 per share or so. I don't know.
Yeah, it's like I'll pull that up. It's like 170 right now. The GameStop stock chart is just ridiculous, isn't it?
Yeah. So at that time, the company had 63% of their shares outstanding shorted. And after the share buyback, which they actually did complete, so they did 30% of outstanding shares. So here in 2019, that little... So yeah, at 2019, around $3-4 per share, the company bought back 30% of the outstanding shares. And that caused the total outstanding short to go from 63% to over 100%. And
wow.
And yeah, I mean, the company essentially could have bought back 99% of its outstanding shares with just half the cash that it had.
How quickly did they buy back those shares, Karan?
I think in a few months.
Okay.
Like the volume was quite high.
Yeah.
So they executed the 30% buyback very easily. Yeah.
Mm-hmm.
I'm surprised it's still trading at that price. That's the one thing that just jumped out. I thought they dropped back in price significantly, but they're still up an incredible amount since before the short squeeze.
What's the market cap right now?
I think 13
billion.
15 billion.
They've raised a lot of capital, haven't they? Like they've taken advantage of that big run up in stock price.
So they bought in at 3 and then they sold out at like 300. So they got 100 bagger on themselves.
Wow.
That's so good.
Yeah. But literally the entire short squeeze happened because of the buyback that the company had done earlier. Yeah.
Playing chess.
Yeah, I wasn't actually familiar with that. So the short interest was already quite high, like 60%, and then they
60%, yeah.
sort of artificially like took it to the moon, and then we all know what happened after that.
Yeah, it was public knowledge. The thing is, the reason the situation was a bit weird is because, how can you have more than 100% of the shares outstanding shorted? Right. So clearly there was something funny going on with derivatives and everything behind the scenes. So it was not really the company that orchestrated it. It was other institutions that got greedy and decided to lend out shares that they clearly didn't have. So, I mean, I'm always going to side with the company. So,
Yeah, nice. Karan, can you talk us through what your selling strategy was like through this whole saga? Because I remember looking at the price action and just like shooting some messages back and forth with you at the time, and it was going up like 50, 100% in a day.
yeah, so it was a bit different. So on eToro, where there's actually money for other people that's being managed, I started selling it like around $30-$40 per share, and all the way up to like 300-400. And that was because I had to manage the risk because it's other people's money. My personal portfolio, I didn't touch it till it was like at 400. So I just let it be, and I'm like, okay, I think even in the long term the company's going to do fine, because the short squeeze I felt like was just somewhere not at the peak but like kind of getting started, and it went up to like $500 per share, and that's pretty much where I sold out in my personal portfolio. It was more of an afterthought for me to sell. Yeah.
And that's such a unique situation to be in, where you paid, what was it, around $4 or $5 per share when you first bought in. Yeah. So even when it's up to 400, you could just accept that this could go down so far and you're still going to have a great return on your $4 buy-in price. Yeah. So that's one of those, a very weird situation that's probably very unlikely to happen again, but it's pretty cool.
Yeah, so I had to be careful with other people's money. It was very different, the selling, as opposed to my own personal funds. It was very different. Yeah.
Well, it sounds like it was also that 100 bagger status that kind of triggered the decision, right, Karan?
That's my price target.
Absolutely. I didn't want to sell before it like hit 450. So, yeah.
You got anything else for us that you're not selling until like 100 bagger?
Well, there's one company that I'm investing that is going through a special situation, but it's not 100 bagger. So it's IWG, which is the largest flexible office operator in the world. And they recently announced that they are willing to look into breaking up the company to unlock value for shareholders. So the CEO and the founder, basically the same person, he started the company like 30 years ago with one center, and he's grown it to like 3,000 now. And in his view, the company should be worth double what the current market cap is. So what they're entertaining is splitting the company up into like the owned property section, and then the franchise section, and then spinning off the technology base, the app, with a SPAC, and listing that on the US market. So it's like a different sort of special situation, but yeah, it could be probably a 2x, 3x, who knows. So yeah, that's pretty much it in my portfolio. Yeah.
Nice. And that GameStop's crazy.
There's a comment from earlier on. From SC. It was like the 5th comment, Tom, if you want to pull it up, saying anyone interested in a special sit where a company divested of non-core assets at a good price requires equity traded down to full selling of warrants, which is Green First is the example he's talking about. Is that the company that Mike Mitchell just went on the board of, or is that?
Yeah, that's Mike Mitchell. Mike Mitchell's gotten on 2 boards this week, and this is one.
What's the other one? It starts with a B, Ballantine or something. Ballantine?
Yeah, they're both. What's the guy's name? They're both Carl Seminara entities.
They're all in that. Yeah.
I haven't followed this particularly closely, I must say. Do you know much about this, Frank?
No, I know very little. Only other than when he appears on the Value After Hours podcast, I've heard him talk about it, but it seemed too complex for me. SC also messages me a fair bit about it, but it seems like one of those interesting plays. I kind of stayed away just because of the commodity aspect of it, which I really don't think I could understand. They're kind of betting, so lumber being the asset that they're, or the commodity, I guess, which they link to housing prices and interest rates and everything else. But it just seems like a difficult one to understand.
Yeah, and I mean, my very basic understanding of this is it was more or less a spec. I thought, well, not a spec, but it was more or less just a pool of cash, I thought, and then they'd gone out and acquired this lumber mill, and like lumber prices have gone nuts, and that's kind of what happened with the stock price here, just going bananas. And yeah, I don't particularly understand the sort of warrant side of it. I wonder if that explains why the stock's come down so much. There was like a big return of capital. I'm not 100% sure.
And the price of lumber dropped significantly as well. So I'm assuming that's a big part of the drop as well.
Yeah, I'm not sure.
Yeah.
It's a hard one. I mean, talking a little bit more about Jeremy Raper, like I see him post commodity stock kind of ideas on Twitter all the time, and they're like 2 or 3 times earnings, but commodity prices for a lot of things are just insane right now. So I'm like, is it really 2 or 3 times earnings, or are they going to have earnings just fall off a cliff with some of these companies after, a year or 2? Or I don't quite know. It's pretty hard to get behind some of those investments from my end.
It really depends on the commodity. Like, I think if you look at gas right now, going into the winter, you could probably see it either sustain or even increase slightly. So maybe not the same for other commodities and stuff, but gas seems to be the one that, has huge like long-term tailwinds also.
And I guess some of the special situations to do with commodities, I guess you're kind of looking for something where the price of the commodity doesn't matter too much, where the company's just so undervalued, even with a very low, say, 10-year average of that commodity price, where even if it drops, you still have a chance for at least downside protection where you won't have a loss on your investment. And then if you get that additional upside from an increase in the commodity price.
Yeah, I mean, my very limited understanding of Green First is that that's kind of how Mike Mitchell was viewing that situation. He was sort of running the numbers conservatively and it looked okay. And I think he's just had this massive kind of unexpected like run up in lumber and it's just kind of exploded. Yeah.
Yep.
Do you guys know what was the market cap when he bought into Green First?
To Green First? Geez, okay. Well, right now it's about 330 million, and I don't know exactly when he bought in, but it looks like it. Yeah, looks like it was maybe about a 4x since then. So,
okay.
Yeah, under 100 million, I think.
Okay.
But yeah, not entirely sure.
Yeah.
It sounds like there's a few complex things going on here with like, if you were to look at it on an enterprise value basis, like they've got a whole bunch of cash and then maybe some of that's been distributed out into other things. I don't know enough about it. All right, Brad, what do you got for us?
Yeah, so when I heard we were going to be talking about special situations, 2 things come to mind. One was Jeremy Raper and how he's really been talking about reopening plays a lot on Twitter. And, I look at that and I think, well, there's so much risk there with some variant coming out and just shutting everything down again. That's kind of what I'm seeing as a pretty high possibility. I mean, it's already starting to happen, right, in Australia and New Zealand. So, I have no interest in that kind of special situation. The other thing that came up was through Value Line, there is a monthly special situations service report. Okay, so if you're a member of Value Line, which I got kind of through a loophole, I got a membership at Fairfax County, Virginia Public Library as a non-resident. It was like $30 per year, and I get to access Value Line from my computer just through that library membership. And so I'm looking at the special situations report for September, and there's two new recommendations. There's Schrodinger and Pure Cycle. And, someone reached out to me, I think in YouTube comments or on Twitter, about Pure Cycle. And now I'm realizing, I think, why they reached out to me. They probably saw it here. But anyway, Schrodinger is... it's a physics-based software platform that enables discovery of novel molecules for drug development. Okay, so it's like, pharmaceutical companies, pay for this software to discover new drugs. So that's pretty niche. That could be an interesting opportunity for people who have that in their wheelhouse. And then the other one is Pure Cycle Corporation, which is a diversified land and water resource development company in Colorado, in the Denver, Colorado metropolitan area. So those are kind of the two recommendations in the latest report. But I was looking at the top 10 performers since the last issue, just over the last month, and Big Five Sporting Goods showed up. And I'm pretty sure that was a Magic Formula pick that went through my last round of quarterly Magic Formula buys. So I should probably pay a little bit more attention to this. I haven't really gotten into special situations. Back when I was maybe a year or year and a half ago, I kind of dug into spin-offs a little bit. But it seems like everyone has so much access to the financials, even for these tiny spin-off opportunities, that it seems like a lot of that opportunity that Greenblatt was talking about in the Yellow Book has kind of been arbitraged away over time because of just how readily we can access all of that data. So, those are just the two that I wanted to share. I am curious with Jeremy Raper. I wonder if his subscribers have access to kind of his performance over time. It looks like he went pro, he calls it, in 2015 as an investor. So it'd be interesting to see over the last 6 years how he's done with these, deep value investments, which it seems like that's mostly what he's doing. But yeah, I'll leave it there. If any of you guys want to add anything, feel free to chime in.
Well, just with Jeremy Raper's subscription service, I have had access to 2 or 3 different write-ups on there just through a person on Twitter that probably shouldn't be sharing them, I guess you could say. But in that, it's just a stock write-up. So you pay for the service and you receive a stock write-up every time he has an idea. So
right.
I don't know if there's different tiers to that service, and maybe you do get access, but I think only shareholders in his fund would probably have that information.
Cool. And I think he's still posting on Value Investors Club. So if you guys, you can look him up there to see what he's posted recently.
And a lot of his write-ups that he shares with his subscribers, maybe about a month or so later, he kind of releases just on Twitter and stuff anyway. So I guess you're kind of late to the party in that sense, but you still get to see how he's thinking about these ideas, which is cool.
Sort of a VIC model right there. And I think he's the guy that really allowed me to dive into Shinnikin. He did some good work on Shinnikin maybe last year. Right? What's that?
He sold out of Shinnikin.
He sold out. He didn't like the donation. I think there was a donation that the founder of the company made to some school or nonprofit. He didn't care for that.
Did you say Alibaba or Shinnikin? Just
yeah.
That's an interesting question from Clayton. Has Buffett invested in any special situations in his career?
Berkshire Hathaway.
yeah.
Pretty much his early days of investing were all special situations.
Yeah, I agree. I think they're sort of, many of the cigar butts, I suppose, are special situations, particularly if you went activist, also, I guess.
Yeah. But
which
really,
ones are those, Glenn?
The 2008 bank investments with Goldman and with Bank of America, those are both only unique to him. So
right.
Mhm.
I mean, you could call American Express a special situation, right? With the
Definitely.
whole salad oil scandal. Yeah. So I think it's probably pretty common for him to get in when there's something wacky going on, right?
I guess it's probably worth describing what a special situation is. I don't
Right.
know where I heard this definition, but it might have been Jeremy Raper, but it's just value investing with a catalyst. Is the simplest way you can think of it. Just some kind of event or catalyst, essentially, that's going to happen, that's going to make your investment possibly have more potential upside in the near future. So, and there's so many different types of situations, that Joel Greenblatt book being a great example that's full of them. But yeah, they're not rare to come by. It's called a special situation, but they're everywhere.
Right. Yeah, I think early on in Pabrai's write-ups on Value Investors Club, he would end it saying value is its own catalyst. So yeah, there's a lot of ways to look at that.
I think that's why Value Investors Club, down the bottom of every post, they have to have a catalyst section, which is part of Greenblatt wanting to see those special situations, I guess.
Right, because that's where he came from.
Yeah, I mean, just as anyone's not familiar, so the special situations Joel Greenblatt covers in this book, there's quite a few kind of different ones. So he talks spin-offs, rights offerings, mergers, risk arbitrage. Then he talks about recapitalizations, leaps, warrants, and options. So there's quite a range of kind of things that he's covering there. I guess one of the main things I got from that book was the special situations or the interesting stuff he was finding often wasn't in the bit everyone was kind of paying attention to. Like, so for example, there'd be a spin-off, maybe the I don't even know what you call it in that example, but the original kind of parent company, I suppose, they were keeping a lot of the debt. Maybe the really good profitable company got spun off with no debt and it was like free to lead its own life, and everyone thought, yay, this is going to be fantastic. And then Joel Greenblatt would actually focus on the original parent company that's like now super highly levered and no one wants to read the filings or pay attention to. So that was something I found pretty interesting too.
That's Host, Marriott, and Marriott, right? That's the example.
I think it might be actually, yeah.
Uh-huh.
Because Host Marriott there's one of them was basically just selling the name and like required basically no capital.
Separation between the franchise model and the owned model. So that's kind of what Marriott had done. And then he went with the one that seemed more levered and cheap and then made a great return on that.
Because nobody wanted it. Yeah.
Yeah, and I've never done this, but I think we've mentioned it a couple of times on the stream. That book is also the place where I got the whole idea of using leaps on sort of binary situations as well. I think, Karan, you might have used them somewhere before, but basically anytime there's like, you think the range of outcomes only includes basically two possibilities, and one is like going to zero and one is quite attractive, you can get the same kind of risk return profile with a smaller, chunkier portfolio by using like long-term options and that sort of stuff. I haven't done it, but that's a strategy that interests me.
Even Seritage, a company that three of us are invested in, and Frank was invested in, that's also a bit of a special situation.
Yeah, I mean it's misunderstood. Like it looks like they're extremely short on cash, but they can kind of make cash available from selling properties, and it's going to take a while to kind of come out the other side and hopefully be cash flow positive. So,
I was surprised by the sales, the two properties that they had recently, the two for 47 million. Like you mentioned that you had estimated the value to be around 18, right? When you guys did the live stream, 18, 19.
Yeah, that's Brad's work that I just sort of steal from him, but that's what was in there. Yeah, which is cool. I mean, you can talk to this maybe more than me, Brad, but it sounds like there's a pretty wide range of property values in that portfolio.
Very wide, from like a couple $100,000 to, I don't know if there was any $100 million property. There might have been, yeah. And are they there's pretty wide ranges even on like a per square
square foot or per acre basis, I think, as well, from memory.
Yep.
Here's Matt. Brad
Thanks,
did good
Matt.
work
Appreciate
on SRG. Brad did great work on SRG, yes.
But yeah, that is another good example of a special situation, even just in the sense that it was just a spin-off from Sears, is that right? In 2015, which is when I think Buffett in his personal cat, is that true that he bought that? And then Monish Fabra was first entered in around that time too. So that's another Buffett
Monish was in
example of
Sears, he
a
wasn't
special.
in Heritage.
Who's
Didn't
that?
he buy in and then
Buffett's
exit and then buy in
Heritage.
again?
He bought into Sears and then exited. It wasn't. He bought into the
Monish.
parent company.
Okay. Yeah, okay.
Right.
At least that's what I remember.
And is that the one that Charlie just kind of shook his head at Monish? Monish was like, all right, I'm selling. That was a great story.
Yeah. Which was a good decision in hindsight,
Right.
looking at what the stock did.
Right.
Right. Okay. That must leave me. So I'm going to cover Curate. So Curate Retail. They own a few different brands kind of under that umbrella, but QVC, the infomercials you see on TV would be kind of the main one. So this is a situation I've heard Bill Brewster on the Value After Hours podcast talking about a fair bit. I have never invested in Curate, and I don't have intentions to, but if I was familiar with the situation maybe 12 or 18 months ago, I think it may have been pretty interesting to me. So I'm just going to share my screen again.
So this is like infomercials, right? Mostly what Curate makes money from. Nice. Wow. That takes me back to the Tony Robbins era, right?
What do we got? Cool. You guys seeing a stock chart, hopefully?
I'm seeing a little wheel thing. There we go.
Okay, sweet. So, Curate is not a growing business, and it's had kind of a rough ride stock price-wise as well. They have John Malone as a controlling shareholder at Curate. So John Malone, I think, has written about in The Outsiders, isn't he? I haven't actually read that book, but he's sort of like known as the cable cowboy and has a pretty good track record.
I don't think he's actually one of the 8, but he is mentioned throughout it, I think.
Okay, gotcha.
It's right behind me, I'll check.
There we go. So yeah, what do you got for us, Frank?
Just look at John Malone's here. You can keep talking. I was just curious.
Right. Cool. This is like, what did Brad run off and get that time? Like a Moody's manual or something?
Yeah, that's right.
Moody's manual.
That was great.
Oh yeah, John Malone is in here. He's CEO number 4.
Yeah. Okay. There you go. So John Malone's a controlling shareholder, and they had for a long time tried to return capital to shareholders. So as I understand it, they were doing quite a few buybacks in sort of 2015, 2016. And the stock really didn't move from kind of doing those buybacks. So they did kind of start looking at other options. And the special situation I'm talking about here is actually relatively recent. So it's a little over a year now. I believe in about August, they announced sort of a 2-part special dividend. So if we look around July, August, the stock's, ballpark $10 a share. And basically the 2-part dividend, part of it was a cash dividend. So they'd planned to pay out about $1.50 in cash. And they also planned to take some of the equity from the business and basically list a preferred stock as well. So if you do the maths on that, you are also getting about $3 a share from the preferred stock. And that preferred stock you can sell in the open market, but if you continue to hold it, it paid about an 8% dividend on that preferred as well. So if you add those two things together, you get $1.50 from the cash dividend. You get $3 from the preferred stock, and the stock's trading at 10. So net, what you're effectively paying for is about $5.50 a share. You can like $4.50 kind of back pretty much straight out the gate. So you're paying sort of $5.50 for what remains afterwards. So that's what happened here. In sort of September, we saw this big drop off in the stock price. So that was kind of around the time that these special dividends were paid. And what was really interesting, you guys are still seeing, hang on, I'm just going to switch over to ticker here. You're more or less left with like a really highly levered equity afterwards, which I will show here. Hopefully that's coming through. So I've pulled up two different valuation kind of metrics for Curate. So if we look at September 2020, like immediately after that big drop off from when the dividends were paid, the valuation is really interesting. So this thing had a heap of leverage. The market cap after the spinoff was about 2.4 billion, but the enterprise value was 10 billion. So, you know, kind of like buying $1 million property and putting $250,000 down and borrowing 750 is sort of what we're working with here. It is quite highly levered, but it was trading at about 2 times and some change free cash flow on an EV/EBIT basis. You know, after taking out all of that leverage, it's more like 6 times earnings. But the reason this is really interesting is, I mean, the way Bill Brewster and I think Mike Mitchell, who we mentioned with Green Forest Products, was actually in Curate or is still in Curate as well. Is you still have a good business. It's not growing particularly fast. It's probably shrinking, if anything, but it still produces a lot of cash. And the way they viewed it is, you know, if it's trading at 2 or 3 times free cash flow, like you really only have to bet on the business surviving for 2 or 3 years. It's not like paying 50 times earnings for something that's growing at 20% a year, and you kind of have to be right for 20 years to get a good result from that. You can be right for a relatively short period of time on the actual underlying business and still have pretty good results. So, yeah, that's one I found interesting. Haven't bought into it, but I think it's a nice case study.
Sounds like one of those Pabrai, the market confusing risk and uncertainty kind of bets.
Yeah, I think
so.
I
think Mike Mitchell was talking about this recently too. I think he actually bought more, and he's under the impression that there will be a special dividend, or maybe that was Bill talking about that. I might be mixing up who it was, but a lot of shareholders seem to think that this is going to be a repeat of what happened last year.
Yeah, I see we've got SC in the comments. I think he's left a few comments on my Curate video I've done in the past as well. So I think Bill Brewster is, from listening to him talk about QVC, I think they are banking on a lot of the capital just continuing to be returned to shareholders. They have paid down a little bit of debt, as I understand it. Like, I haven't got the screen share up anymore, but the gap between those multiples, like the price to free cash flow and the EV/EBIT, has shrunk, which suggests that there's been quite a lot of kind of deleveraging going on. So I think they see that as kind of like accretive to the equity, and then I think they're just straight up kind of betting on more special dividends at the same time to actually try to get some cash out of this thing. It's one thing for the business to earn it, but if they hold on to it all the way into bankruptcy, that's kind of not very helpful, right? So I think that's how they're thinking through it. All right, should we jump into some questions?
Let's do it.
Rightio, I'm going to scroll all the way back up to the top, but if you got any questions, drop those in the comments. What do we got? Is Jack at another wedding? I think
he
so.
actually. No, I think he is. I think.
Is he?
Oh no. He has one coming up, but it's not today. Yeah.
Okay. Yeah, I think it's more of this lawyer stuff, I think.
No, I think he's wheeling and dealing real
what
estate.
that's
That's what's happening with Jack right now.
Okay.
Yeah.
There you go. Brad's back. Yay.
Yes.
Welcome back, Brad.
Thank you. Thank you.
All right. Any questions jumping out to you guys?
After dinner has a few recent ones to kind of directed at all of us. He's spamming us in here as usual. He asked Brad about SRG, and he asked me about the bank that I bought recently, and he asked you about Stellantis as well, Tom. So,
crikey. Okay, should we do SRG? Let's do that one first.
Sure. Yep.
Brad, SRG at $15. Is it attractive? Both SRG and Barber are both down, but you only added to Barber. What are you doing, Brad? Why not SRG?
Yeah, I put a pretty high conviction bet down on SRG back when it was $10. There might be some price anchoring going on here. Shame on me. But I haven't felt compelled.
Slap on the wrist.
I know, right? To look at SRG again. It's just kind of something I've tucked away, and I'm going to see what happens over the next 5 or 10 years. So nothing super rational or deep intellectually to report there.
Mm-hmm. Has anything sort of fundamentally changed with how you view SRG? I mean, I'm just looking at some of my own transaction dates here. Like it's been, where am I looking? It's been pretty much a year, maybe a year and a couple of months since we kind of were buying into SRG. I mean, we've had the property sales kind of continue. We've had some of the redevelopments continue. We've got a new CEO. Any groundbreaking thoughts on that you
no
have kind of changed how you think about?
There's nothing that's changed the thesis for me. So yeah.
Okay. Yeah, that's fair.
How much bigger is your Baba position compared to SRG, like on a percentage basis?
Oh, I gotta dig it up.
Like twice, triple the size.
What it's I'd say my Baba is like maybe 30% bigger.
Oh.
Yeah.
Wow.
So not too much bigger.
I'm working with similar percentages, but I'm the opposite way around. So Seritage is a little larger than me. I actually have added to Seritage this year, so I'm pulling up some dates here. My most recent purchase was in 17th of August at $15 flat. So I've been buying it somewhat recently. And I'm kind of in the same boat. I don't think anything really fundamentally has changed. I did have some concerns with all the management turnover that was going on, but I kind of like what Andrea Olshan's been doing so far, at least. It's a multi-year kind of scenario to see how it plays out. So time will tell, as it always does. But that's how I'm thinking about it at the moment.
Just to push back on the other side of it slightly, so he said it's back at $15. So is it super attractive again? I think the further we go out, the less attractive $15 is because they are burning so much cash. So $15 last year isn't as appealing as $15 right now. I think they're burning about $2 per share of cash. So unless there's some underlying upside that we aren't really able to calculate in, which could be the case. And I guess as shareholders, that's the bet you're making. But just on the numbers alone, it theoretically isn't as attractive at the current price.
Yeah, I disagree. So the thing with Seritage is it is levered, and it's levered to the property market. So property prices very conservatively are probably up 10% in the US. And I think ballpark numbers, when Brad did that work, was the assets is something like $80 a share. Debt and preferred was something like $50 a share. So if that asset has gone from, 80 to 88, then that adds $8 a share in equity. So I think that more than outstrips the cash burn. But it is a good point. And they've got some debt
you're probably right.
payments coming up in the next year or two as well.
Yeah. And more. Go ahead, Karan.
Yeah. The big debt payment is in 23, right? So there's still time to structure things, sell properties.
Yeah, is it 23? I was actually trying to look at this the other day, to be honest. Maybe I'm just not looking in the right place, but I was looking at their debt maturities, and I found it kind of frustrating to look at actually in the 10K, because with a lot of companies I've looked at, it says this is what we got due in 2022, this is 2023, this is 2024, this is 2025, like very straightforward. But theirs was like, this is what we've got due in the next year, this is what we've got due in the next 1 to 3 years. And it's like, can you just give me a more specific timeline? I'm sure that data is available and I can go dig it out.
I've seen it somewhere. If I find it, I'll share it. But I think it's July of 2023 that they have the 1.6 billion.
Well, Tom, you just have to have Danielle Town on your podcast, because I think Matt Peterson hired Danielle to go through all of the debt literature for SRG. So she knows.
Is that right?
Yep. That's what he
Check if it's a
mentioned in
recourse
his
and not recourse and stuff. Is it?
in his last annual meeting. Hey guys, we just got an $8 super chat. Are
Super
you
chat.
seeing this right now?
Hey, Brad, $7.99. Thank you to how do you pronounce that? IEM THI. I apologize for the name, but
And the A, is it Australian dollars? Is that what am I reading that correctly?
Oh,
You
yeah.
guys know?
Yeah, must be.
Probably.
Must be. Okay, cool.
Australian viewers. Right. How many rounds would a fight between intrinsic value versus political risk? I didn't even read the super chat before I pulled it up. Intrinsic value versus political risk will last, and the winner with super investors as the referee. Thanks. I don't know.
It depends on the number of rounds.
So I guess this is just relating to Alibaba directly. Right, intrinsic value is by far more important in my mind. Political risk, if we're applying it directly to Alibaba, typically I'd like to avoid political risk. There's a lot of smaller emerging markets where that's certainly a risk I would avoid. This specific example of China, there's definitely regulatory risks around it, but I'm kind of under the impression that intrinsic value is far more important and going to offer a lot of returns in the long term. Political risk is probably, well, these regulations are kind of hurting the intrinsic value slightly, but I think the intrinsic value is growing a lot faster. So in this case, intrinsic value wins by knockout.
In the first round, Frank?
No,
First
intrinsic
round
value is a
being-
long-term weighing machine type thing, isn't it?
Probably round 3,
It's-
political risk has the advantage, but then by round 7, intrinsic value comes in.
Okay.
Yeah, I think political risk comes out swinging, but it's kind of like a tortoise hare type situation where, and actually the tortoise is quite quick in the situation of Alibaba.
We just got to stay in the ring, guys. We've got to stay
Yeah.
in the ring.
It's a tortoise on speed versus a hare. That's what
Yeah.
I think. Okay.
Fair
That's
enough.
of that.
Good.
Right. But thank you for the super chat.
Yes, thank you.
Very kind. All right. Any other questions jumping out? What should we take?
I can jump on the bank one if you want from After Dinner Investor.
Yeah. Oh, there we go.
So the bank I just bought is Hingham Institute for Savings, so HIFS, trades on the NASDAQ. Do you think it's worth more per share than you paid for it? No, I think it's about fairly priced. Maybe even on a historic, if you're looking back historically, it's probably slightly overvalued on a book value per share type basis, but they are a better bank than they have been in the past, so they're probably around fair value. It's kind of hard to judge that, but the margin of safety for me doesn't come on valuation. It comes in the quality of this business. So that's kind of how I'm thinking about it. So yeah, I guess outsourcing capital management, like you said in the comment there. So I think they can grow at about 15%. I don't know if we'll get much multiple expansion from that. I think it's more just the earnings growth that we'll see over the long term.
Frank, did you take a look at what happened to this bank in 2008? Any lessons there?
Well, they handled it better than almost any other bank. Their loans really survived through that. There's a chart on my Twitter. We put it up last week, I'm pretty sure, or whenever it was I talked about Hingham here on the podcast. So, they handled it really well. It was probably a great time to be investing. Their share price dropped as everything did, but their business was barely impacted throughout that time. And being a really efficient bank with low expenses and everything else, they really do well during hard economic times.
Cool. Speaking
How
of
much
banks,
was
have you guys looked at Bank of the Ozarks at all? A big Phil Town position.
I only very surface level kind of just comparing it with Hingham's, but only some of their numbers. I didn't go into any detail about the company at all, really. Just some of their metrics like return on equity and things like that.
Frank, how much would the price need to drop for you to make this thing a full position?
If it was trading below 1.5 times book, it's about 2 times book right now. I'll be willing to bet more. If it come down to 1 times book, it would turn into a Kelly Partners type size position for me. So, right, yeah,
cost presumably.
Yeah, cost. Yeah, so I put about 6 or 7% of my portfolio roughly into it at the moment. Normally, I like to use around that 10 to 15% as an entry buy-in for my portfolio. But yeah, if it was, say, 25% cheaper, then I would probably increase that position. If something happened in the market and it dropped significantly and it was down 50%, then I would bet heavily.
It looks like it was down at like 1.25 price to book at the depth
During
of the
COVID.
pandemic. Yeah.
Yeah. I wish I knew about it at the time. That's when I first heard about it. So the Focus Compounding, Jeff Gannon, the guy on the podcast there, they have a fund as well. It's one of their 4 positions. And he first started talking about it about just over a year ago on a podcast. He kind of comes across it on the podcast live and he's looking through some of the numbers and you can hear how excited he is about it. So I did hear about it then, but I just didn't think twice and kind of didn't revisit until a few months later when they bought the position.
Mm-hmm. All right. I think we're going to have to hold off on any more after dinner investor questions for a little bit. But
Okay, we're giving him a timeout. We're giving him a timeout.
Yeah, well, this man's
He'll
he's
have
played
to pay
the odds
for it
quite well.
But James's question, the most recent one.
That's a good one. Also,
right.
I think
What do we got?
Charlie contacted you about buying in, right? He cloned you on that.
Yeah, Li Lu has actually stopped taking Charlie's calls, so now Charlie calls me, which is great. I actually averaged down before I found out that Charlie bought again, so I was pretty excited to see that. I probably got a better price again than Charlie did, so well done. Well done.
Very nice.
Yeah.
I mean, Charlie's initial purchase must have been like 250, right?
Yeah,
Ballpark.
definitely above like 227. I think that was like the low of the quarter that he bought. So somewhere in the 225, 250 range, I'm guessing.
Yeah, nice.
Yeah.
And I mean, how significant an add was it? Because it was close to a 20% position already, wasn't it?
It was an 82% increase in number of shares. So almost a double in share count.
No, for you, I mean.
Oh, for mine.
Or have you cloned that as well? Did you clone the same allocation? And then
I didn't do that.
82%?
Didn't do that. It wasn't a big ad for me. It was in my son's UTMA account, kind of tax advantage account. So it was not a big one.
Mm-hmm.
But more to come, perhaps.
Yeah, I mean, if it keeps going sideways for long enough, I mean, I'll have some more cash coming in the door and be trying to find a home for it. So,
right.
All right. Here's an interesting one from Clayton. Facebook stock is near the top of buys on Dataroma. Anyone here considered a position in the FB?
Yeah, it was on my watch list during the depth of the pandemic. And it went below my buy price, my target buy price, and I didn't buy it because I had my market timing hat on. But actually, since then, I'm less and less excited about owning Facebook, and I think where that's coming from, I don't really use Facebook anymore. I use Twitter, I use YouTube. So personally, it's kind of lost its utility as a platform. And Instagram, I don't use much anymore either. So, I'm much more interested in looking at companies like Google and Twitter as opposed to Facebook at this point. But
Are
that's
you a
not to say
shareholder
it's
in
not a
Twitter?
great business. What's that? I don't own anything in Twitter, but it's something I'm watching. Yeah.
Yeah, it's interesting. I also missed Facebook during the March 2020 dip. I didn't have my market timing hat on. I just straight up missed it.
You were navel gazing.
It all happened so quickly. Yeah, I was navel gazing. I was probably paying attention to GraphTech going down 50% on me or
Right.
something. But I just straight up missed that one.
Yeah.
Yeah, I should have bought it. A mistake in hindsight.
On a price to earnings basis, they're trading about the same as they are at the bottom of the pandemic. So in March, they traded about 23 times earnings. Now they're about 24 or 25 times earnings. So theoretically, they're just as cheap now as they were at the bottom of the pandemic.
Yeah, I actually hadn't seen those numbers, but one of the things that was interesting with when was the Cambridge Analytica scandal? Was that 2019?
18, I think.
18, I think,
18?
yeah.
Mhm.
Yeah, because it was interesting. I mean, because Facebook dropped quite a bit there as well. I've got the stock in front of me.
Big time.
Yeah, so they got down to about 18, 19 times earnings then, just on a PE basis.
Yeah.
It fell like 40% or something.
Yeah, so it's had a few drops in here. So it went, where's the top? There somewhere. Yeah, 40%.
Yeah.
And then it dropped in here.
I mean, there were like
30%.
campaigns, right? Delete your Facebook. I mean, it was going viral. That kind of thing was going viral.
Yeah, on Facebook probably.
Yeah, right.
That's the thing. The thing I was going to say on that Cambridge Analytica thing, even though I wonder if I'd have to look at it, a price to sales ratio, I hate using those, but that might be an interesting comparison of March 2020 versus today, because I know coming out of the Cambridge Analytica scandal, their operating costs grew a lot faster than their revenue for the first time in a long time, and sort of margins shrunk a little bit. So I wonder if, even though it's the same PE now versus March 2020, whether there was some like dormant earnings power that wasn't kind of showing up in that 2020 number.
Yeah, so it was about 5 to 6 times times revenue in the bottom of the pandemic, and now it's about 8 or so. So yeah, you are right there.
Yeah. Okay. Yeah. So that's interesting. I don't quite know how to quantify that revelation, but that's something to think about.
I think being a company with such high margins and earnings growing so fast, I'd like to think about their earnings probably more than their top line. But
yeah,
regardless, I think Facebook is cheap now, not cheap enough would be my surface level without really diving into much. The main reason is I'd be concerned about the long-term growth of a business that's already that large. For me to buy into a company that big, it would need to be down fairly significantly below intrinsic value, like Alibaba, for example. Not as big, but the same type of mindset around that. But I think that they must be about a $1 trillion company, or give or take, I'd say. Yeah, so it's just a bias of mine that I don't know, could be a bad thing. I don't know, but I don't like to buy into something that large that's already been growing so well for a long time. I'm sure there's a reasonable amount of growth left, but maybe as like a 5-year investment, it might be more appealing than a long-term investment, assuming you get some type of multiple re-rate moving forward.
Yeah, it seems to have always traded at a little discount on an earnings multiple to like a Google or I don't really know which other one to throw in that basket. It probably hasn't with Twitter, but to Google or certainly to like Amazon, that's been wild. I'm just going to put this out there. Do you guys, I mean, I'm pretty sure I know you guys' answer to this, but the whole sort of like dormant earning power thing I was just talking about before with Facebook, do you get a similar sort of feel with that's the case with something like Alibaba as well? Any takers on that? Like, I mean, you've got the cloud business in there, for example, that's not profitable. Like, that contributes zero to the bottom line right now. And I've heard Monish kind of just mention that in passing before, like, it's trading at 20 something times earnings or whatever he was saying a few months back. But there's a lot of earnings sort of yet to show up, I suppose, that aren't kind of included in that multiple. Plus, you've got like the Ant Financial stake as well.
Yeah, I think the cloud business is definitely the main appeal, like the underlying upside that I really like about Alibaba. The e-commerce business is great, but I don't think there's anything exceptional going to happen there. It's probably just going to keep growing at a reasonable rate for the foreseeable future. But it's whether or not that cloud can do what all the other Western cloud businesses have been able to do and generate these high margins, very high quality moat type business, which it seems to be just reaching those stages now. I think on an adjusted EBITDA basis, they've just reached profitability. So we could say in the next year or two, it'll be a profitable part of their business, but probably not for 5 years. We might see those underlying earnings really start to generate, a kind of significant portion towards the overall business, because it still is such a small part, even on the top line for Alibaba.
Mm-hmm.
I think Facebook is more similar to Tencent in that sense, where they kind of focus on certain business and then they have a huge amount of cash that they've been investing. Kind of seems very similar to what Tencent has done, more than Alibaba. Yeah.
Do you have thoughts on that, Frank? I don't know enough about Tencent to.
Yeah,
really say much
Tencent's
about
probably one of the best comparisons to Facebook, other than the fact they're in completely different geographic regions, so like their markets are different. But the type of business out of these tech giants around the world, they are somewhat similar. Like none of them can be compared perfectly. Like you can't compare Apple, Amazon, Microsoft, Facebook. People always do, but they're such different businesses, different margins. Everything about their operations is different. So the only thing that's really been compared is that they're huge businesses. At least Tencent has a social media aspect, being WeChat, so you can compare that slightly, I guess. Yeah.
Mm-hmm. Yeah, cool.
Even in WhatsApp, they're integrating payments and they're doing a lot of things within WhatsApp. I know in India they've started integrating payments directly on WhatsApp, so that's similar to WeChat in a lot of ways.
Yeah, for sure.
Yeah.
There was a question about where is Monish Pabrai and why isn't he putting out more content?
Oh, is that guy's timeout all done?
Oh, or was that him? Never mind. I never saw that question. Yeah, I wonder if you finally got to visit Nick Sleep. Did you you have any insights on that, Tom?
What, Monish meeting Nick Sleep?
Yeah, visiting Nick Sleep, paying him a visit to thank him.
I don't know. I have heard through the grapevine that that Guy Spears in the UK right now. I don't know if that means much, but that's all I can say. That's all I can say.
No further questions.
Yeah. Okay, we'll let Jason off his ban. Here's one. How many pages did the host read this week?
I didn't read any actual books, but I read a few annual report pages from Hingham's. That's about it.
Yeah, nice.
Not much.
I've been yeah, we're all voracious readers this week.
Right?
I've been trying to get through Good to Great by Jim Collins, and I'm pretty sure I smashed out half the book in like, I don't know how long, but fairly quickly. But I'm taking a while to get through the end of that. I probably read like 30 pages this week, but that's about it. It's underperforming for me.
Yeah, it's harder for me because I listen to most of my stuff on Audible. So
who knows?
Yeah, who knows?
Yeah, I do listen to a lot of podcasts pretty religiously, but who knows how many hours that all adds up to.
Right.
All right, we got a last couple of questions that are jumping out to you guys at all. Jason's just realizing he's in trouble.
Yeah. Karan, do you want to talk at all about your green thumbnail today? I haven't seen it, but there's some controversy in the chat about what's going on. So maybe you can.
Goodbye.
Okay. We're not going to
Yeah,
probe Karan on that one.
Green
Okay.
thumbnail.
Yeah, it's just basically September portfolio update. That's the thumbnail.
Gotta love
I
it.
receive so much shit every month for the one video that I put up. It's like, how can you say, you're up like this percent in the year, you're down so much? I'm just like, here, September portfolio update, whoever wants to watch it, watch it. It's mainly for the people on eToro. So,
I see.
yeah,
Nothing flashy about it, huh?
to the
Yeah.
point.
We could do a live reaction now if you like. I haven't watched it.
Sure. It's just a green
Well,
screen with September portfolio update. That's it.
Like 3-second video. That is that the video as well, or that's just the thumbnail?
And I go through the portfolio.
All right, we're going off track again. Any last? If you got any final questions for us, please drop them.
Is there a track, guys? I didn't know we were on a track, so I apologize.
I don't know. I feel like at about an hour 5, hour 10, pretty
Yeah, we start
consistently
to.
go off the rails. Yeah.
Usually start talking about UFC or cricket or something.
Yeah, we can't give Jack any cricket trivia this week. We could move to Brad though.
Yeah, I'm sure Brad knows absolutely nothing about cricket as well.
That is very true.
I think people in the chat can give us topic ideas because that would be really helpful.
Yeah, we're
Yeah,
running out of topics for the
Yeah.
episodes.
This may have come from the chat, did it? Or maybe the 100% portfolio one last week.
Yeah, last
Yeah,
week
that
came
came
from
from the
Karthik.
chat.
Yeah.
What are the boys doing this weekend?
Okay,
After
let's
dinner,
see.
investor says.
This is a classic
All right,
closing
we're off
question.
the
Right.
rails now.
You go first, Frank.
Honestly, I've got nothing too exciting. Bit of family time, and then I have my live stream tomorrow, doing ticket time with Tom joining me. I think. Are you still? Have you cancelled your weightlifting, or you're all in?
Yeah, it was dependent on me being out of lockdown to go do strongman training. I was like, I'm doing strongman over your live stream. Sorry, Frank, if that's what it comes to. But no, our lockdown's been extended, unfortunately. So I'll be available.
With the sad face.
Yeah. No, it's going to be great. It's going to be great. It's
Absolutely.
episode 2, right, Frank?
Episode 2 tomorrow
Episode
at.
2.
Oh, the time's so confusing now, but it's 12 p.m. Australian Eastern downtime because we're in daylight savings. So
Gosh.
it's
Eastern downtime.
what's that? It's about an hour and a half before this podcast started.
Yeah.
Is when we
I'm absolutely terrible with time zones because New Zealand has one time zone, and like that's all. I don't need to know anything else. It's only since I've been doing YouTube things and we've had punch card and stuff that I've had to try figure this out. Or like for the podcast, figuring out like I'm having Jason after dinner investor here back on the podcast in a week or two, I think, and trying to figure out what time it is, and I think he's in Oklahoma City versus New Zealand.
Well, whatever 2 hours and 40 minutes ago, whatever that time was for you, 2 hours and 40 minutes ago, that's when it will start tomorrow.
Yeah. Or can't you click on you can click on the YouTube videos, I think, and it gives a countdown.
Yeah.
generally,
That'll give
if
you
you've scheduled it.
a timer.
That's a life hack. Okay.
Life
All right. What's everyone else up to? We've gone off track. Brad, what are you doing this weekend?
What am I doing? We might go to like a pumpkin patch with the fam or something like that,
Oh.
since it's Halloween coming up. So
In the spirit.
that should be fun.
What does one do at a pumpkin patch?
Yeah, what do you do? Well, usually there's apples as well, since those seasons
Right.
coincide. So drink some cider, maybe have some apple pastries, and pick out
Yep.
the perfect pumpkin for Halloween. That's what we're
There
going to
you
be
go.
doing. Yep.
Are you allowed to take your very own punch card brew glass for the cider?
Probably.
Yeah. You'll have
Should
to
I
put
do
that on
that?
Twitter.
Okay. There you go. That's not a bad idea.
Absolutely. All right. Karan, what are you up to?
Just family time, I think.
Family time.
Fair enough.
No further
And,
questions for
I-
Quran.
No further questions.
I might actually like
My girlfriend.
space. Yeah,
You're
Oh, yeah.
doing what,
Nope.
Karan?
this space might be gone. So like, I might be giving up this area, this office space, and then shift out. Maybe not this weekend, but during the week. Yeah.
So,
So I'll get
no
moving
pumpkin
into new
patches
space.
over. No pumpkin patches in the UAE for this weekend.
I don't know if Karan is quite in the phase of the pumpkin patch phase.
I don't think pumpkins would survive here. Like they'd be like cooked, before they could actually ripen. Yeah.
Desert pumpkins. That'd be good.
Yeah.
Right. Yeah.
That'd be shriveled up, dehydrated
We've got
pumpkins.
cactus patches now.
Okay.
The desert pumpkin. You get the cactus. Yeah.
Yeah, nice.
Good.
All right. And what am I up to? My girlfriend just made some corn fritters before this live stream, which were quite good.
Ooh.
Nice.
Other than that, I'm locked inside, mowed the lawns this morning. I'm in that lockdown phase where when we first went into it, you'd mow the lawns probably about 3 times as often as you need to, just for something to do. And and now I'm at the stage where I just can't be bothered. So it was quite overgrown, but that's fixed up now. And then tomorrow they'll be on Frank's live stream. So that's my week.
Awesome. Tom, you strike me as a push mower kind of guy. Is that accurate?
Oh yeah.
Oh yeah. Yeah. You gotta
Wait,
push.
you got one of those 0-turn ride-on models, or what are you working with over there?
I don't do lawn mowing, but yeah.
He's got the permaculture going.
That's it, Frank. That's it.
Okay.
Yep.
I'd pictured you with like the Forrest Gump, Bubba Gump shrimp hat on, just like best job in the world. No?
Yeah, I should take a picture of that too for Twitter. Yeah.
There you go.
Random side note: there's a house just up the road from me, and it's got the best grass you've ever seen in your life. And an old lady will sit out there for hours cutting it with scissors. No lie.
Oh,
Is that right?
So she must mow it properly first, like it already looks good. But I think just to like tidy up areas,
Wow.
she's out there with the scissors. I can't believe it.
That is nuts.
She should
value
start a
investor?
YouTube channel.
Yes.
Yeah, legit. Yeah,
Watching grass grow.
She would do well.
that's a little niche right there.
Yeah, she's a lady of leisure, just
Yes.
letting the portfolio do its thing.
We should have her on one time.
Yeah, we should.
Okay. We're totally off the rails now.
This has gone south. Okay, let's wrap it up. I'm surprised we've still got 46 people watching. I think we had 47 or 48 like before we went
Wow.
off the rails. So
Very
people love it.
impressive.
We've just lost one. Okay, we better stop before we go further downhill. Thank you, everyone, for watching. We will be back next week, and hopefully you have a much more professional host in the form of Jack Duffley, but I did my best. Right. Signing off. Thanks, guys.